Have you ever seen a company whose stock price is way higher or lower than its actual balance sheet? Now, why does that happen? In today's video, we will learn about the concept of book value multiples in a very simple way. We will look why market value and book value are different. We will understand why price to book ratio is important and what are the factors which can influence it and how we can use it to spot whether a stock is overpriced or underpriced. Let's understand the multiples. We use simple tools to calculate the difference between the market value and the book value. Now, the first tool that we use is price to book ratio. PB is equals to market value of equity divided by book value of equity. We use a more broader version of it, that is enterprise value to capital invested, where we remove cash from both the company value and book value so that we can only focus on the operating assets. PB ratio is different around the world and also across the sectors. Around the world, in US, many companies trade above 2 times the book value. In Japan, many companies trade below 1 times what they are valued, which is less than their own book value. Across the sectors, in banking sectors, companies trade at 1.3 times their book value, whereas the tech companies trade around 4 to 5 times their book value because investors think that they are expected to grow faster. So what drives the PB ratio? So why some companies have higher PB ratio while others have a lower PB ratio? It is mainly because of return on equity, how much profit a company is generating on its shareholders' money. In simple terms, a company with higher ROE deserves to have a higher PB ratio, whereas a company with lower ROE tends to have a lower PB ratio. Therefore, if a company surpasses its investors' expectation, it deserves to have a higher market value. So how can you spot whether a stock is underpriced or overpriced? Yours is a 3-step filter which you can use in any industry to check whether a stock is overpriced or underpriced. First is to check the PB ratio. If the PB ratio lies below the sector median, it means that the stock looks cheap. Second is the ROE. Is your ROE above the industry median or not? Lastly is your stock volatility, whether your stock volatility is less than the industry median or not. If your stock fails all these three, it means that your stock is overvalued. Now, if it passes all three, it means that it is undervalued. Therefore, book value multiples aren't complicated if you actually understand that what drives them. If we focus on ROE, cost of equity and growth, we can easily spot whether a company is overvalued or undervalued. Thank you.